It's no secret that I love talking about interest rates and housing and really everything about real estate, but let me just do a quick little blurb about purchasing power. So your purchasing power is always the highest when you're paying all cash because you're saying, yes, the home is $700,000. Here's $700,000. It's mine. Excellent. Now I just have to pay taxes and utilities and insurance and the expenses to keep the home going. But in the grand scheme of things, you really own the entire property when you're paying all in cash, right? Most people, though, don't have $700,000 just to pull out of their pocket and throw on their home purchase. So the majority of people, of course, have mortgages and other forms of lending to help make that affordable or possible. So when you have a loan, there's always interest on that loan because whoever's lending you the money also wants to get paid, right? So they're charging you interest. And that's where this interest rate comes in. When it goes up, we pay more to interest than we do to the principal of the loan. And that's the amount that you have remaining to owe. So when your loan is fresh and new, let's say you have a $700,000 house and you need a mortgage for $500,000 of it, you are paying interest on that $500,000. Whereas let's say 5 years down the road, maybe you only have $400,000 left to pay on the loan. Your interest is based on that $400,000. Of course, interest rates ebb and flow, as we've learned, especially this year. So that's just something to keep in mind. It's best to pay off your mortgage as soon as possible, as long, and here's the caveat, as long as you are not making the same return on investment in another area. Let's say you have a stock portfolio that's doing really well and you're making an 8% return on your investment. Well, then that can counter the 5% that you're paying right now. So this is really important to understand, and it's really interesting, at least I think so. So if you have any more questions about it, please reach out to your mortgage agent or your financial advisor and really ask the questions. There's no such thing as a dumb question, so make sure you get all your answers up front. And most people's mortgages, keep in mind, are going to renewal in the next few years. So make sure that you start planning for that. Of course, you can't plan down to the detail since the interest rates will ebb and flow, as I've mentioned, until then. But you can at least have a good idea of what your options are leading up to that date. So be proactive and see what your options are and talk to the professionals who know this stuff inside and out.